morning. This is Andy Cates from the Global Economics Department at UBS. The idea that the developing economy world would decouple from a global financial crisis was always a tough one to sell, and it's now been well and truly debunked overnight with news that China's economy is beginning to feel some pain. China's GDP in the third quarter slowed to a 9% year-on-year rate, some way below the market consensus of 9.7, and about a point or so below the estimate for the second quarter. On the output side of the equation, industrial production, the key metric for the commodity complex, slowed to just an 11.4% year-on-year rate, 2 percentage points below consensus. Now, some of this slowdown can be pinned on Olympic-related shutdowns, but there's a growing sense amongst policymakers and in the media that the economy is feeling the pain from the financial turmoil in the rest of the world, with credit demand weakening and the property market apparently cooling quite rapidly. Against this backdrop, policymakers are laying some groundwork for a stimulus plan, and various measures on both the fiscal and monetary front are expected within the next few days. The macro calendar is pretty light in the week ahead, with hardly any data points to gain inspiration from in the US. Though given last week's raft of numbers, perhaps it would be more pertinent to say lose inspiration from. Europe, though, does see a raft of business confidence data from various bodies and various countries, including the early read from purchasing managers on Friday. Most of these, we suspect, will be fairly weak. It's pretty difficult, after all, to feel confident about one's health after a heart attack. And the financial sector, as politicians appear to now have worked out, can of course be likened to a heart pumping credit through the arteries of the economic system. The degree to which these arteries are still clogged will still be very much in focus this week, with investors naturally keeping a very close eye on money and credit market stress. The bad news is that TED spreads are still a long, long way from levels that would typically earmark what might be described as a condition of financial sector health. And that's despite the concerted attempts to resuscitate the system by central banks and politicians in recent weeks. Note on that score that ING Barings was the latest European bank this weekend to get some government help with a capital injection of some 10 billion euros from the Dutch government. The good news as regards money market stress, according at least to a Wall Street Journal article over the weekend, is that JP Morgan has loaned between 10 and 15 billion US dollars in short-term unsecured funds to overseas peers at rates between 3 and 4.5%. And that in turn, again according to the Wall Street Journal, could lead to a drop of some 50 basis points in Libor today. As for broader research-driven views, our asset allocation team's latest weekly offering suggests, partly for reasons concerning still difficult credit market conditions, that it's still somewhat premature to re-engage more fully in global equity markets. Current valuations, when adjusted for cyclical earnings weakness, are only fair and not cheap. Somewhat alarmingly, company analysts have actually been raising 2009 growth estimates over the past few months, when the revision cycle, of course, from economists has been moving the other way, and as yet is probably incomplete. The view toward markets is, for these reasons, still cautious and defensive. That's all for today. Thanks very much.